Welcome back, everybody, to Volatility Trading Strategies. So I've got a new option trade type to introduce today that I think everybody's really going to enjoy. Now, a quick recap. One of our portfolio allocations is called the VTS Discretionary Option Strategy, and it represents 30% of our total portfolio. It's almost entirely options-based, and it serves two purposes. First and foremost, it is a great addition to our portfolio, as option trading can be a great diversifying tool, as well as a source of solid growth. Secondly, though, it serves as a teaching strategy where I'm going to be sharing some things completely free that you're not going to find anywhere else. My way of giving back to the VTS community by sharing a wide variety of option trade types, breaking down how they work, talking about entry and exit points, risk management, everything you need to know to make this a part of your investing knowledge. So if you are interested in options trading, feel free to open a paper trading account through your broker and then head over to my website and claim your free trial where you can see how we use this trade and many others like it. So let me get into the details of what I call the vol step strategy. Anybody who's familiar with some of the volatility exchange traded products on the market, like VXX, TVIX, UVXY, for example, have no doubt looked at a long-term chart and had the same thought go through their head. Take a look at this chart of the UVXY since inception in October of 2011. What do you think when you look at it? Adjusting for all the times it's done a reverse split, the UVXY has gone from over 48 million to below $10. Is that real? That doesn't even seem remotely possible, does it? But actually, yes, that's exactly what it's done. So of course the first thing everybody thinks about when seeing this is, why not just short some shares outright and hang on to them indefinitely? Clearly the natural tendency for UVXY is to approach zero, right? Well, that does seem like a good idea in theory, but there is one glaring problem with this strategy, and that is, when volatility events do occur, long volatility ETPs like the UVXY can spike extremely fast and be catastrophic to anybody holding short shares. Although the product didn't exist during the last financial crisis, by using the VIX futures, we can actually simulate approximate values for the UVXY as if it did exist. And had it been around back then, it likely would have spiked about 1,500% or so in 2008 and early 2009. Even if a person only held, say, 5 or 10% of their portfolio in short UVXY shares, a volatility spike like that could wipe them out. Remember, shorting stock holds with it unlimited loss, and a 1,500% volatility spike could put you in a world of hurt, even on a small portfolio allocation. Now, you might be thinking, well, that's fine, I'll just hang on to the shares for the long run. After all, the UVXY does eventually come back down, and I can recover, right? It's just a matter of patience. But what if your shares get called away? That does tend to happen when you least want it to. What if your broker forces a liquidation? What if volatility products themselves go through structural changes, or even worse, just disappear entirely? If this past February has taught us anything, it's that we have to be prepared for the unexpected. So who knows what could happen while you're waiting for your shares to recover? And if all of that doesn't convince you for some reason, what about just the simple opportunity cost of tying up your capital in an underwater trade? Remember, recessions are great opportunities, and that's when you want to have liquid capital, not be tied up in a previous dud. The bottom line is, it's just not a good idea to hold short shares outright for any extended periods of time, even if it is just a small allocation. And that's especially true on something like the UVXY that can move 5 or 10 times as fast as the S&P 500. We need to be tactical with our volatility investing, and fortunately, there is a much smarter way to short the UVXY and still capitalize on that incredible roll yield decay that the product suffers from most of the time. And that's where the vol step strategy comes in. Here's a chart of the UVXY going back 12 option cycles to illustrate. All of those red hash lines are the monthly options expiry dates. And all of those white circles are the price of UVXY on those expirations. Notice how the UVXY tends to make lower lows over time? It's not always the case, of course. You can see in February 2018, it did spike up for a few months before continuing its decline. That happens. But if you look at it in a certain way, it starts to resemble steps, right? That's why I call it the vol step strategy, and the goal is simple. By analyzing a variety of volatility metrics and market indicators, I try to determine the best time to enter a vol step trade by buying a vertical put spread on the UVXY, hoping to capitalize on another step down in the following expiration. If done right, it can be a nice little profit maker as the UVXY bleeds down. Every step lower in that option expiration cycle can pay off. but there are a few rules that we need to keep in mind. First, it's absolutely imperative that we keep these trades very small. I don't care how good you think you are at predicting volatility markets, at some point you're going to have a stretch of losing trades, as these steps can also go up rather than down. If you allocate too large an amount per trade, a few losers in a row could really cost you in the long run, so keep the trades small. Second, we can't just do this blindly. I know there's going to be people watching who think, well, great, we'll just do this every single month as the options expire and reload it over and over again. Maybe even use the weekly expiry so we can get more trades in. Well, slow down, because the options market is way too efficient for that to work. Everybody and their dog already knows about the decay of long vol products, so there's no edge in a rinse-repeat strategy. I know there's traders on Twitter who do this, and they pretend that they found some super secret money-making machine, but they only show their wins, they always hide their losses, and any success they've had is usually just the result of an advantageous bull market period. Just like any other option strategy, it lives or dies based on analyzing the volatility metrics and market conditions in the moment, and then knowing when to put on the trade and when not to. Blind churning won't make much money in the long run because, first of all, at some point markets are going to start going the other direction. And secondly, the negative roll yield is public information and it's already fully accounted for in the options premium. And the last rule to keep in mind, these trades need to be completely independent of everything else in your account. We may need to open and close them at various times, so they can't be tied to any other trade in your account. These aren't hedges, and they aren't there to offset any other positions. These are standalone trades, and we do need the tactical freedom to open and close them based on current market conditions, which can change quickly. So let me show you an example of a recent trade we took within the VTS discretionary option strategy to illustrate. When UVXY was trading right around $9, we opened a 9/8 long put spread expiring in the next monthly cycle, which was September 21st, 35 days from when we opened the trade. And you can see that just a week into our live trade so far, it's already moving in the right direction, more than halfway to full profit. For those not familiar with put spreads, a 9/8 means that we are long the $9 put option, and then in the same option expiration, we are short the $8 put option. This creates a limited loss trade where we can only lose the amount of money we risk up front. Remember, shorting shares outright, even on smaller amounts of capital, can get out of hand quickly when things start to go wrong, which at some point they will. To be a successful long-term investor, you have to expect the unexpected is going to happen from time to time. So these put spreads are great because you can only ever lose the amount of capital you put up. And the remaining information there, we've got the number of contracts, the expiration date, and the premium paid to open the put spread. For this trade, which is live in our VTS discretionary strategy and still open as I'm making this video, we want the UVXY to be below $8 by the September expiration. That's our maximum profit range. The maximum loss happens above $9. But again, we've defined how much that is from the beginning, and we already know that it's well within our risk tolerance level. So the structure of the trade is actually quite simple. It's just a vanilla put option on a product that does have a natural tendency to decline over time. We open them at the most advantageous times, taking into account all the volatility metrics, and then it's just a matter of capitalizing on a continuation of this step-down expiration cycle. As we move forward in time, and I stress that under normal market conditions, which of course isn't all the time, but under normal market conditions, the UVXY steadily declines. And our strategy looks to capitalize by setting our maximum profit range above where we expect the UVXY to expire in the next cycle. So hopefully I've done a good job explaining the basics of the vol step strategy and why it's been so profitable for me personally over the years. However, I really do want to stress that it's not feasible to just put these trades on anytime we feel like it, or to do it like clockwork every month and expect that to work. The options market is very efficient, and success is based on an understanding of what works and what doesn't in different market environments, and then just mastering entries and exits and putting on the appropriate trades at the right time. There's a near endless list of potential indicators to take into account, and it's this ability to assess the important ones and then react accordingly that produces consistent traders in the long run. And hopefully I can help you on that journey. So if you are interested in this trade or any of the other ones I've already introduced, or the ones I will introduce in the coming months, feel free to sign up for my newsletter. And lastly, of course, I'm always available to answer any questions you have, so feel free to reach out anytime. I'm always here to help. Thanks for watching. So go ahead and click the link right here, sign up for the VTS newsletter, and when you do, you're going to get full access to all of my trading strategies for a full month absolutely free. And if you are new here, please consider subscribing to my channel. Also, if you have any questions or comments, I'd love to hear from you, so go ahead and leave those in the comment section below. See you next time.